One of the best ways to learn about a new product is to compare and contrast it to a similar product which you're already familiar with. Following this approach is a great way to get familiar with tax-free savings accounts, also known as TFSAs. Now, you're taking the WME course, so by now you probably have a pretty good handle on RSPs from what you've learned in previous courses, and perhaps even from your real-world experience. But if you'd like a refresher, you may want to watch the video lesson called RRSPs and 3 Key Points, where my colleague discusses how RSPs work at a high level. Let me quickly recap the takeaways from that lesson. Number 1, when you contribute to an RSP, that amount is deducted from your income, thereby saving you tax dollars in the current year. Number 2, any income earned within the plan is sheltered from immediate taxation. In other words, an RSP provides tax-sheltered growth. And number 3, when any funds are withdrawn from the RSP, the entire withdrawal is taxed at the investor's marginal tax rate. Now, unlike RSPs, TFSAs do not provide a tax break when contributions are made. So this often causes students and investors to think, well, then they're not as good as RSPs. Well, this isn't necessarily the case, so let's dig a little deeper. Recall that RSPs provide tax-sheltered growth. In other words, the tax is deferred. However, TFSAs provide tax-free growth. Think of it this way. Why else would they be called a tax-free savings account? Let's look at an example. In 2009, Jack opened a TFSA and invested $5,000 into the shares of a penny stock, trading for 20 cents per share. Jack had always felt good about the company's prospects, and he's been proven right. The stock is now worth $40 per share. That's an increase of about 20,000%. His TFSA is now worth $1 million, and he's obviously ecstatic. He's just withdrawn every penny from his TFSA and purchased a beautiful cottage on the lake and a brand new sports car too. Remember, withdrawals from TFSAs are tax-free, so that means Jack doesn't have to pay a single dime in taxes on his $1 million withdrawal. Now, consider for a moment if Jack had made the exact same investment within an RRSP. For the purposes of this example, let's assume he's in a 50% marginal tax bracket. The percentage return and total profit would have been the same as it was in the TFSA, but since RSP withdrawals are taxed at the investor's marginal tax rate, Jack's $1 million withdrawal would have resulted in him having to pay $500,000 in taxes. Jack might still be able to buy a cottage, but maybe not on the lake, and he'll still have to use his old car to get there. As you can tell, at SeeWhy Learning, we often use exaggerated examples to drive home the learning. So with this in mind, please don't take this example to mean that we're recommending investors purchase speculative penny stocks within their TFSAs or RSPs. Let's highlight the differences between RSPs and TFSAs by filling out the table on the screen. There is no minimum age for RSPs. As long as a Canadian has earned income, he or she can set up and contribute to an RSP. To contribute to a TFSA, you must be at least 18 years of age. Contributions to an RSP lower an investor's taxable income, thereby saving him or her tax dollars. Contributions to a TFSA do not lower taxable income. In other words, there is no immediate tax savings for the investor. RSP contribution limits are indexed to inflation. TFSA contribution limits are also indexed to inflation, but the limit is rounded off to the nearest $500. For example, in 2019, inflation caused the limit to move past $5,750, which means it was rounded up to $6,000. Income earned within RSP is tax-sheltered. Income earned within a TFSA is tax-free. Withdrawals from an RSP are taxed, and withdrawals from a TFSA are tax-free. As you can see, TFSAs and RRSPs share some similarities, but they do differ in meaningful ways as well. Knowing both will serve you very well as you prepare for your exam. Okay, so now that we know how each of these accounts compare, let's have a look at calculating an investor's TFSA contribution room. But before we get into an example, it's crucial to point out a special feature of TFSAs that do not apply to RRSPs. That is, any withdrawals made from a TFSA can be recontributed back to the TFSA at a later date. Consider Leslie. In 2009, she made a $5,000 contribution to her TFSA. In 2010, she withdrew $3,000 because she was having some financial difficulties. She hasn't made any contributions since. She asks you to calculate her TFSA contribution room. For this example, let's assume today is January 1st, 2019. The table you see here shows the maximum allowable TFSA contribution limits for each year from 2009 to 2019. The total for these years is $63,500. This means that up to and including 2019, an eligible investor would have been able to contribute up to $63,500 to his or her TFSA. Now, since Leslie made a $5,000 contribution in 2009 and a $3,000 withdrawal in 2010, her net contributions to date are $2,000. This means that as of January 1st, 2019, her remaining TFSA contribution room is $61,500, calculated as the difference between the maximum allowable contributions of $63,500 and her net contributions of $2,000.